don't know if you're aware of the Skippy peanut butter. I usually have that almost every day. Minimize Ziva, but the way you read, check Google as well. So Google, Tesla. And the last one is going to be ZooMedica. Ticker name, ZO, Google, Tesla, and ZooMedica. So it's over here. What is up, you guys? Welcome to this lecture on how to implement the Markowitz efficient frontier, which enables us to solve the Markowitz Portfolio Optimization problem on Python. In English terms, if you have a bunch of stocks that you would like to invest in, well, what is the best strategy to allocate your budget in those stocks? So for example, if I have the following stocks that I did my research on and I found that there's potential in these stocks, such as Siva, Google, Tesla, ZooMedica, well, if I have $1,000, how can I distribute this $1,000 into those 4 stocks? This study could be replicated to any number of stocks. So all you need is a starting date and an ending date and you're good to go. Along the way, we'll be using different modules such as Pandas Datareader, Datetime, Pandas, NumPy, Matplotlib, and SciPy. We're going to define some financial terms such as the returns, the log returns, the Sharpe Ratio introduced by William Sharpe, the so-called chart that tells us the returns versus volatility or risk. And last but not least, we're going to introduce some optimization problems that enables us to plot the efficient Markowitz frontier on your return versus risk chart. So without further ado, let's get started. So the first thing you'd want to do is open your terminal and get Jupyter Lab ready for your environment. First, go into your directory, which in my case is Markowitz. Type in Jupyter Lab. Once that's done, you're going to see the Jupyter Lab opening for you. Hit select for Python 3. We don't need a console. Open a notebook and call it whatever you want. I'll just call my file main.ipynb. Okay. So a really useful Python module for reading in stock prices, opening, closing, high and low, volume traded, and all those good stuff is Pandas Datareader. Now there's a lot of modules, I know, but the most efficient one that I found was Pandas Datareader. So to import that into your environment, all you need to do is type in import pandas_datareader.data and give it a certain alias. I'll use web. And I'd also want the date time to specify the starting and ending times of my window. So for the starting time, I'm going to be on the 1st of January. Okay, even though that was closed, even though people don't trade stocks at that day, well, it starts on the date that is the closest to the 1st of January. Of course, a date that comes after the 1st of January, not before. And likewise, for the ending date, I'll specify, let's say, what do you want me to call it? Where do I stop? Let's say I stop on the 22nd of January. Right. Okay, so we're at a point that, okay, I specified my starting date and my ending date, but I still need the stocks, right? So here's where you should have done your research and you have a bunch of stocks that you want to find the best, let's say, strategy to allocate your budget. Let's say for the moment, for simplicity, right? Just for the sake of presentation, I have 4 stocks. We did our research. We came up with the following 4 stocks since we were told by some genie that they are good. Now, of course, there's no genie in real life. A genie is not going to come and tell you, oh, you have those stocks and, you know, they're going to perform well. Just throw money in those stocks. No, you did your own diligent research and you found out that those stocks, you know, there's some potential in them and I'd like to invest in those stocks. But the real question here is how much in every stock. Let's say you've got $1,000. Well, do I allocate $250 in each of my 4 stocks? That's one strategy. It might not be the optimal one. It's just one way of allocating your money. Now, there's smarter ways of allocating your money, which Markowitz tells us how. And I'm going to be showing you a really nice way how. It's using the Markowitz efficient frontier, We're going to pick a point on this frontier that maximizes the returns and at the same time minimizes the investment risk, right? Let's say I did my research and I have the following 4 stocks. So I've got Siva, the way you read it is using web.datareader, pass the ticker name, the source, which in my case is Yahoo, and the start and ending date, right? I'm going to check Google as well. So Google, the ticker name is Google without an E, source is Yahoo, and start and end. Let me copy paste this twice. Third stock is going to be Tesla, and the last one is going to be Zomedica, ticker name ZOM. So to make sure everything is working, just hit shift and enter, and there you go. This is, for example, Siva. We have the high price, low price, opening, close, volume for each date. Okay, now since we want something more compact, we want them all in one data frame, I'm going to concatenate all of them using pandas. So pd.concat, but for that we need to import pandas. So import pandas as pd. So let me type this down on another cell because this takes time. Look, 1, 2, 3, 4, 5. So it took me around 5 seconds to execute this line of code. That's because we're reading from a certain API. So there's an exchange with the web. It's not due to my machine's power or speed. No, this is reading with the API. So it depends on the connection speed. Anyways, so over here, I'm going to concatenate using pd concat all my closing prices. So we're interested in the closing prices of each of the stocks, right? So we've got Siva, we've got Google, we've got Tesla, and we've got Zomedica. There you go. All are concatenated. But if you go ahead and type in stocks as such, it's not pretty informative, right? It looks really messy. That's because we need to define column attribute. Define each and every column. So the first column is Siva. The second one is Google. Third one is Tesla. And the last one is Zomedica, right? Now let's check. Still didn't work. Oh, I think I know where the problem is. For the concat, so the concat function, as you can see over here, this is its description, and the signature right here is an axis. So if you go down here, the axis 0 is index and 1 is columns. We need 1, not 0. So going back here, we'll define an axis equal to 1. And this is a columns, not column. And there you go. So for each date, we've got the closing price of the stocks of interest. Siva, Google, Tesla, and Zomedica. Right now, I've got all my stocks, right? I've got all the prices in the window that I indicated. Next, let's compute the returns, right? And for the returns, this is the formula I'm going to be using. So it's RT, so the return at time t or date t is PT over PT minus 1. PT is the price at date t, and t minus 1 is the price at date t minus 1. So to do that in Pandas, all you have to do is define the variable, the data frame returns as stocks divided by stocks dot shift by 1. Shift each column 1 to the front, right? So this is my returns and it looks like this. Of course, the first date is not a valid number because you're dividing by nothing. You grab this PT and it's divided by nothing behind it, right? So it's not a valid number. Else, all seems to be good, okay? Now next, we're going to define the log of returns. Why the log? The log is a function that favors or promotes fairness. So if you have a stock that is really high in price and another one a bit lower, like the case, let's say Zomedica is very low, so 0.3, 0.4, 1, 1.0, whereas Google is high, really high, 1,000 is at an order of magnitude. You've got 4 digits before going to decimals. Tesla, you've got 3, Siva, you've got 2, right? So to, have some sort of fairness among all the stocks, we use the log of returns, right? So to compute the log of returns, let's define log returns, that is NP log, and NP is NumPy. So going back up here, or if you want, we can do it here. Import NumPy as NP. We're going to use the log of NumPy on the returns, and then we'll print that out. And there you go. This is the log of returns, right? So now we're going to define a really important term in finance and in stock market analysis, which is termed the Sharpe Ratio. This term is named after William Sharpe, which was founded in 19 1966. William Sharpe is an American economist, and he won a Nobel Memorial Prize in economics in the year 1990. He's well known for capital asset pricing models and, of course, the Sharpe Ratio. Now, what is the Sharpe Ratio? The Sharpe Ratio is defined per portfolio. So for every portfolio, for every strategy that you suggest, there is a corresponding Sharpe Ratio. The Sharpe Ratio is defined as follows, and it is the risk, the return with risk. So this is R of W. W over here, we will see as we code along, W is going to stand for weights. So over here, a certain weight vector is a 4x1 vector, right? If I go down here, W is going to look like this. It's a normalized weight vector. So all my W's add up to 1 as such, right? And what does this tell us? It tells us that what is the proportion of the budget that you should allocate to each stock. So W1 is the proportion of my budget I should allocate to SIVA, W2 to Google, W3 to Tesla, and W4 to Zoo Medical, okay? So RW would be the returns if you chose vector W, right? So in case you allocate 0.25, 25, 25, 25, for example, RW for that W vector would be the returns, that is, it's W transpose times the vector of returns. So that would be your returns. And RF is the risk-free return. It's a return defined in an ideal scenario when you have no risk. As we will see, as we code along, we don't need RF, right? We don't need this term as it is common to all weights. What we're trying to figure out is the weights, right? Keep in mind that the weights over here is what I'm looking for. This is the vector that I want at the end of the day, right? So that's what I'm looking for, the best strategy, the best weight vector. So what I really want, what I'm really going to look for is RW and sigma W. So what is sigma W? It's for the weight W, it's for the weight vector W. What is the standard deviation or the volatility that I have? So how do I compute RW? Since we're dealing with log returns, then my RW would be the W transpose times log R. So as a small example, let's say I'm interested in date 7. What is the log return on this day? It would be W1 times this, plus W2 times this, plus W3 times this, plus W4 times this, okay? This is captured in W transpose times log R. And what is my volatility over here? It's the square root of the variance, right? So the variance is the term within the square root over here. It's the W transpose sigma W, no? It's this guy over here. And how do I compute sigma? Well, it's the covariance matrix of the log returns. And it's easily computed as this matrix. So if you grab this matrix, you get this transpose, and then you multiply it by itself. We'll see it's easily computed on Python using one command, the COV, the covariance command. So once you have this, you can get the Sharpe ratio that is proportional to the ratio. Notice that we neglected the risk-free parameter because as we will code along, we're looking for the W that maximizes this term, right? Right, so now we're going to put in a really informative chart that is the return versus volatility chart. This chart is going to summarize all possible portfolios. So for each portfolio, I'm going to be able to read its corresponding return and volatility all in one chart. So we're going to generate almost all possible portfolios and put them in one informative chart. And to do that, first let's define the number of portfolios that I need. Let's say I'm interested in 10, I'm going to generate 10,000. Now the more, the merrier. But let's say for the moment, I stick on to 10,000. Now we're going to run a loop here on each and every portfolio. So for K in range number of portfolios, I'm going to run a for loop here. So for each one, I'm going to generate random weight vector. I'm going to compute the expected log return, the expected volatility, right? And the Sharpe ratio. That's 4 things I need. So first thing, let's generate a random weight using random function of NumPy. It's of size 4, and we're going to normalize so that it sums up to 1, right? Don't forget this constraint. It's normalized as follows. And last but not least, I'm going to save this weight because I need to index it later on. That's the purpose why. So let's save it in weight, in a vector called weight as follows, right? Okay. And for that, I need to define this weight. I need to initialize it here. So to initialize it, let's initialize it with all zeros of size number of portfolios and 4. 4 is the number of stocks I have. Next, we're going to compute the expected return for this particular portfolio that corresponds to weight W. And how do we do that? Well, we're going to use this formula over here. W transpose times log R. So the way we do it is, what was the name of the vector? Log returns. So we need the log returns multiplied by W, right? So this is pointwise multiplication. Then I need to sum this thing up. Actually, no, that's not the way. So this is an expected, this should be the expectation. So that said, we should take the expectation per stock. So this guy is, we should compute the mean, right? The mean of this guy. And then we should sum this guy up. That's how we should do it. And one thing, since this is common per iteration, then it's better to compute it once, right? So mean log return. Let me copy paste this over here. Compute it only once as such. Coding should be neat. You should be as neat as possible. This is how you compute the expected return. Now let's compute the expected volatility for portfolio K. And we're going to use this formula over here, right? Again, as the mean log ret is common per K, so is the sigma matrix over here. So the sigma matrix is computed as follows. So it's the log returns dot covariance, right? And the way to compute this inner product over here, W transpose sigma W, all you need to do is W dot transpose, you multiply it, so NP dot dot, you multiply it with your sigma W. So again, we need an NP dot dot sigma W as such. Then finally you take, so this is W transpose sigma W, then you need the square root. So NP dot SQRT, like that. And last but not least, you need your Sharpe ratio. So Sharpe ratio of K is nothing other than the ratio. So this guy divided by this guy. Let's put first 1,000 to test it, or 100, because this guy takes time. Let's put 100, and I've got an error. So expected return is not, oh, okay. We need to define 3 arrays as we did with the weight. So the expected return is, let's start NP zeros, size, number of portfolio, and so is the expected volatility. Same thing, initialize all zeros, and so is the Sharpe ratio. Let's run this. Seems to be working good. Let me take a look at expected returns. Okay, let's see if we can plot it. So for plotting, I recommend using matplotlib.pyplot. I've got a tutorial on that. I'll be linking it down in the description section below. Actually, I've got a tutorial on matplotlib. I've got a tutorial on NumPy, and I've got a tutorial on Pandas. I've also got a tutorial on how to use Pandas Datareader more efficiently. It's called Stocks Programming. I'll be linking all 4 tutorials down in the description section below. So yeah, in case you have no background on those modules. So as PLT, let me take a look at how expected returns looks like. Okay, expected volatility. Okay. Now that's not what my priority is at the moment. I'm just checking if the vectors are filled in properly. Let's generate 10,000. Let's wait for that. Okay, it's done. Again, let's try plotting to make sure everything's working properly. Okay, 10,000 points. Okay, good. What we need to do right now is figure out the max index. So what is argmax of Sharpe ratio? We're trying to maximize this guy, right? So this guy dot argmax. This gives us the index of the maximum Sharpe ratio, and so we can get the weights at this location. So max index weights is not the, wait, sorry, it's a weight. So as you can see, we've got the following vector that maximizes the Sharpe ratio. We've got 0.35 for Siva, 0.33 for Google, 0.24 Tesla, and 0.06 for Zoomedica. That's how much proportion of your budget you should allocate. So if you've got $1,000, then 354 should go to Siva, 337 to Google, 244 to Tesla, and $6 for Zoomedica. Okay, right now let's plot the chart. So plot figure. Again, import matplotlib.pyplot as plt, right? So first thing, let's open a figure, find a fig size. Let's say 16 by 16. It doesn't show, so in the end plot.show, show it. And let's plot a scatter plot. So for that, to plot the scatter plot, we need returns versus volatility, right? Volatility sits at the x-axis and return at the y-axis. And so we get this. It's too big. So let me just shrink it down. So 14 by 14, still big. 12 by 12. I'm going to zoom out just to be able to see it while I type along. So 12 by 6, and there you go. Let's go 17 by 6, not bad. 20 by 6, perfect. So this is pretty uninformative for the moment. All it does is have a scatter plot of return versus volatility. Well, actually let me label the x and y axis. Plot.x label. We've got on the x-axis, we've got volatility. Actually, we've got expected volatility to be more precise. And on the y-axis, I've got expected log returns. Okay. Something more informative is to have a colored map that shows where the high Sharpe Ratio regime is. And for that, you'd want to go back up here to scatter and pass in the color map ratios that is indexed by the Sharpe Ratio itself as such, okay? And we need a color bar, right? We need a bar telling us how to read it. So we need a scale, a bar that tells us this color corresponds to what Sharpe Ratio's value. So a number per color. It's called a color bar. Plot.color bar as such, and label it as Sharpe Ratio. There you go. Okay, it would be also nice to have a point where the maximum Sharpe Ratio is. So of course it's in this regime over right here, right? So it is the one that is indexed by max index, right? So it is expected return of max index and expected volatility of max index. So right here, I'm going to plot a scatter plot, only one point, that is expected volatility of max index, and likewise expected return of max index. I'll plot it in red, so it's over here, right? Right, so now let's get the optimal portfolios, or what's also called as the efficient Markowitz frontier, using the vectors that we calculated. So the expected returns, volatility, and Sharpe Ratio. So remember in one of my lectures on the Markowitz Portfolio Optimization that looks like this. So over here, we're minimizing, we're finding the best X, or in our case, the best W, right? That minimizes the risk and achieves a minimum accepted return, right? So this problem could be seen as maximizing the return and at the same time minimizing the risk. So what you're doing is actually the equivalent of the following. So another equivalent problem is to maximize the Sharpe return or minimize its negative. In some references, you find the following, just to keep things consistent with minimize. So we're minimizing the negative of the Sharpe Ratio subject to the following constraints. We could also replace those constraints by a box constraint. So each W is bounded between 0 and 1. It's also possible. You can also find the following formulation. So as such. Okay, so we're going to solve this problem using SciPy's minimize function. And to achieve that, let me zoom in over here. We're going to import from SciPy. Actually, I used to call it Skippy, but it's not Skippy, it's SciPy. Sorry about that. I don't know if you're aware of the Skippy peanut butter. I usually have that almost every day. Anyways, so SciPy, we're going to import the minimize function from SciPy, and we're going to find the optimal W's, W-opt. We're going to minimize the negative Sharpe Ratio. So we're going to start with a W0, an initial guess. We're going to pass the method. So if you're not familiar with the minimize function of SciPy, you have to pass the following arguments. So you also should pass the method. So we're going to use sequential least squares, and we're going to pass the constraints. So first the bounds and then the constraints as such. Okay, and finally we will be printing W off. Of course, if you run it, you're going to run into errors such as what is negative SR, what is the bounds, what is the constraints. We didn't define them yet. We're about to define them. So right over here, we will define a function called negative SR. So defining this function that takes in weights. So it's a function of weights. SR is a function of weights. And what is it? Well, we want the negative SR. So we're going to return negative SR as such. And SR is actually return over volatility, right? What is the return? So for a given weight, so the weights, we're going to cast it as an array to be able to deal with it. And then the return is the sum of my log returns. So if I go back up here, I need the mean log return, right? So mean log return multiplied by weights. So it's actually W transpose log R. That's one. And the volatility is, I'm going to copy paste it from here. This guy, okay? So this is my negative SR ratio. This is the function, right? And this is not minus, this is -1 times, okay? So this is my negative return function. If I run it, it's going to tell me, okay, what is W0? Well, W0 is an initial guess, and let's say it's 0.25 for all, so equiprobable. Okay, this is W0. What is your bounds? Let's go down here. My bounds is going to be according to this constraint. So each WI is between 0 and 1. A proper way to define it is as such, 0, 1, 4 times. Run. And last but not least, what is your constraints? Well, for my constraints, this is actually very characteristic of the minimize function of SciPy. So you're going to have to define a type as such and a function. Okay, so one thing to keep in mind about the minimize function is that we're returning a W vector. Now we're going to check each solution if it sums up to 1 or not. And if it does, check sum to 1. This is going to be a function, which I'll define over here, that takes in weights and returns 0 if it sums up to 1. So np.sum weights -1. If it's 1, it returns 0. So run, and there you go. This is actually the solution. So it's wopt.x. It took 8 iterations to reach this solution. And notice that this vector that you see over here, which is the optimal solution, is actually pretty close to what we found over here. Right? So what we had here, let me copy paste it down here, 0.3545, 0.3542, 0.3375, 0.3441, 0.24, 0.23, 0.06, 0.06. So we actually found the optimal point using an optimization problem. That is, we're maximizing the Sharpe ratio subject to a box constraint on the W. So this is another way of finding your optimal solution. This is another neat way, I would say. So I just wanted to show you this way before going ahead and plotting the efficient Markowitz frontier. I wanted to show you how to use SciPy's minimize function to solve the Markowitz problem in another way, okay? I wanted to show you how to obtain the optimal vector using a formal optimization problem, that is to maximize or minimize the negative Sharpe ratio subject to box constraints on your W's, right? So now the question is, how do we obtain the frontier, which should be on the boundary on the scatter plot? How do we obtain it? Well, we're also going to use the SciPy minimize function, and we're going to solve multiple optimization problems. So for each return, so for each horizontal line we plot, we need to find the best volatility, right? We save all such points and then we plot this frontier. That's what we're going to do. So for each possible return in returns, let's call it that way, returns, we're going to find best volatility. That's what we're going to do. So what is my returns? Well, it's going to be a vector, right? np.linespace, and over here it's going to start from 0 and going back up here. So start from 0 and add something like 0.07. So this is where I'm going to solve, right? Going further than that makes no sense because this is where we stopped. So stop at 0.07 and take about, let's say, 50 points. And for volatility opt, it's a vector that I'm going to be filling up at each problem, right? So over here, I'm going to save my optimal volatility. Okay, so right here, we're going to call minimize again, and we're going to try to minimize my volatility. This is my function, my anonymous function that I'm going to be writing just now. Actually, let's write it right now. So it's a function that takes in weights and returns volatility. Simple as that. So we wrote part of the function over here. Let me copy paste all this right here. Actually, we don't need the return. We don't need this. We need the volatility as such, right? This is it. So we're going to minimize the volatility expression. We're going to pass an initial guess, which is going to be my W0. And as we did previously, we need the method, bounds, and constraints. Let me copy paste all those right here, right? My bounds are the same. My constraints are going to be a bit different. So on top of what I previously had, which is this, I'm going to define, since now we're targeting minimum volatility, this is what I'm, minimizing. I need a constraint on my returns. So it's of type equation, and my function is an anonymous function, and it's going to look something like, so minimum accepted return. This is what my constraint is going to be. So to define that, to call a lambda function w and get return w minus achievable return. Okay, so get return is also going to be a function right here that is going to return me my returns. So we need this w and we need the r so that we return it in the end. So the r we already typed it here as such, and the achievable return is actually the return right here. Okay, and actually this is a keyword, so I'll call it r. R is better because return is a keyword of a function. So we have my optimal, so we solve, we get the optimal point, and then finally we will stack it in volatility opt. So append my opt function value. So running this will take a lot of time. Whoa, it didn't. So let me check this, and there you go. This is how it looks like. And now to plot it on my plot, let me copy paste what I had previously here, because I want to plot on top of it. I want to plot the frontier over here. So what should I do? All I need to do is add plot. We're going to plot volatility opt versus returns. Volatility opt and return. And there you go. There's the frontier that you see. It's all those points on the edge of your region. People usually plot it in using a dashed line. Okay, so all those points are the ones that minimize your volatility or risk subject to a given return. So let's say you have a horizontal line here at 0.03. Well, this point right here is the one that minimizes volatility, which makes sense. That's what the chart is telling us. It's at the edge. It's at the extreme left of any given horizontal cut, right? So one thing here to bear in mind after all this analysis is a very important remark. This doesn't predict the future values of given stocks. It doesn't in any way imply that we're predicting stock values. No, we're only using previous values, right? So as you saw, from the first day of January till the 22nd day of January of the year 2021, we're using this information to find the best strategy to allocate our budget in, okay? We're not using prior information about each and every company. We're not building APIs, going on and scrolling the web to do some sentimental analysis on some certain, articles related to the companies to be able to deduce rise or fall of certain stocks. No, this lecture has nothing to do with predictions. We're only basing our study, we're only studying previous values of the stocks. This is a very important remark to keep in mind. So that's about it. That's all I have to say about this lecture. If you found it beneficial, please leave a like on the video, subscribe to the channel. If you have any questions whatsoever, kindly leave a comment down in the comment section below, and I'll make sure I'll get to it as soon as possible. Also consider donating to my Patreon account any amount you wish. Thanks for watching, and I'll see you in future